They're kind of getting on board. So I guess the challenge really does kind of trickle down to that retail investor, and I guess for them, a lot of them are thinking to themselves, higher returns, higher yields. That usually means higher risk. But what's sort of that relationship in private lending, and how does it kind of compare to traditional fixed income?
Yeah, and this is something that I spent a fair bit of time on, prior to getting very active, in the private lending space, which we are now. When we started looking at what we saw as just a very, very attractive risk reward opportunity prior to setting up our business, and fund to try and capitalize on it, we really wanted to understand was the risk reward really that attractive, or were we just not understanding the risk side? So we did spend a fair bit of time trying to understand the dynamics of the industry and why, that kind of risk reward opportunity exists. We are big believers that there are quite a number of inefficiencies, in the private lending space, which can add to a yield premium. It really varies depending on the lending strategy, but I'll give you an example of a few. The macro thesis behind, a lot of the lending funds popping up, due to, Basel III, Dodd-Frank, banks deleveraging, moving away from, lending to certain areas, has definitely created a void, which, has provided a lot of opportunity for non-bank lenders to come into the marketplace and kind of fill that void. Along with that void came fairly attractive, returns for those loans that were given. In addition to that kind of macro kind of thesis behind the industry, there's a lot of other, we think, yield premiums that you can capture along the way. Size is definitely one. All things being equal, if you keep your lending activity under a certain size, you stay away from the big money, and you can typically capture a little bit of a yield premium. All things being equal, if we do an asset-based loan at $2 million asset-based loan versus a $50 million asset-based loan, we think we're picking up 200 to 400 basis point yield premium for taking on that smaller size where there's less competition. We think sourcing, your focus on origination, and finding these actual loans can actually add a yield premium. Not only, do you want to look at a lot of loan opportunities to find the ones that you like, but by looking and seeing a lot of opportunities, you can sometimes add some yield premium. And not just yield premium, but we typically find that spending a lot of money on origination activities can lower your default rates as well, which adds to your, obviously your net return. As a business owner, which is, where we focus our lending activities towards, there's, when the bank says no to them, that they're not going to lend to them, there's, a lot of these people are lost. There's a lot of non-bank lenders out there, and everyone has their kind of own little box that they stay within. So it's very hard and very inefficient for a lot of these business owners to kind of find out where to go when the bank says no. So it's a very inefficient way for them to find a company that can actually do that type of loan. And then once you do find a company, there's it's not like these things are rated or traded. So it's very inefficient as far as, price discovery on defining that yield. And that leads to, some attractiveness as well from a premium. Maybe lastly, we're fairly heavily involved in receivable financing as well for companies, factoring, which is not really a loan. It's actually a means of helping finance a business whereby we're buying an asset off them, which is their accounts receivables. And, by the nature of, accounts receivable financing, typically the client that we're buying those receivables off of tend to be, non-bankable. Yet the people that they're doing business with tend to be of very high quality. So there's kind of an arbitrage opportunity there whereby we can kind of buy, the receivables, which tend to be of higher credit quality, and yet charge a rate to that client, that is more synonymous with their credit risk. So, there's definitely in factoring, there's a structural arbitrage opportunity there, which leads to higher yields, which is quite attractive.